Morning, welcome to the week ahead video as we're getting ready to quite a busy week. There's quite a few different data points. We've got the Federal Reserve meeting, we've got the Bank of England meeting as well. So there's quite a lot of detail for us to jump into. Now, the week doesn't really get going properly until Tuesday. Monday's a very quiet day. We've got some German GDP data coming out. Now, this is the flash reading, is going to impact the Eurozone data as a whole. Now, Germany is slowing down in terms of its technical recession that's ahead. However, some other European countries are expected to bump up. So not really expecting any surprise from the German data. The surprise will be if it comes in hotter than markets are expecting, and that could give the euro a little lift in the hope that it's going to lift the GDP flash number for the whole region. You can see it's expected, the prior reading is pretty flat. And although we haven't got the forecast in yet, anticipations are that it's going to be quite a flat reading. So not expecting any surprises there. If it comes in lower than markets are expecting nearer the time, then you could see a little bit more of euro weakness as markets start to price in sooner rate cuts coming more quickly. So it is one to look out for potentially for euro weakness. A surprise beat either to the downside or the upside would give either the euro a lift. Particularly, I would be very attracted to the euro having a lift against the pound. With the Bank of England meeting, it's down in this heavy support area in the euro pound, and it's very unlikely that the Bank of England are going to give a hawkish decision. So very likely that they start to signal potential rate cuts. So you would expect the euro to gain against the pound over, or at least in the expectations into the Bank of England meeting. So if we did see, some early strong data out for the Eurozone for the GDP, you could see a little bit of euro pound upside early in the week. So definitely one to look out for, and two-way opportunities there for an out of consensus print. US JOLTS job openings, that will be interesting. If you look at the JOLTS job data, we can see that job openings continues to track lower in the US. Now, this is just the day before the Federal Reserve meeting, so not expecting any major fireworks, but the US economy is doing pretty well. If you take a look at the latest GDP print that came in last Thursday, you can see that's a pretty decent print, 3.3% GDP advance for the fourth quarter 2023. So inflation's falling, but growth is strong. So it's a quite robust picture for the US. And, markets aren't expecting any big surprises from the JOLTS job openings. Yes, it should continue to track lower, but as long as there's not a big surprise, then we'll probably likely see the dollar stay flat to supported heading into the Federal Reserve meeting. That slightly stronger GDP print that we had last week is just keeping expectations that the Fed is going to push back against market pricing of 5 or 6 rate cuts. The Fed themselves have only signaled 3, so it's more likely that the Fed signal that, higher for longer, maybe being cautious, tentative, feeling their way very gently. They don't want to. The last thing they want to do is start cutting rates quickly, because that itself is inflationary. Now, the Wednesday data for Australia will be important as well. If we look at the last headline print for Australia inflation, 5.4%, so it's tracking lower but still well above the RBA target. Similarly, 5.2% for the core percent, double the RBA's target, bottom of that 2% range, and monthly CPI indicator remains strong. So as long as that monthly CPI indicator is strong for Australia, then that keeps the pressure on the Reserve Bank of Australia. First rate cut for Australia is still seen in August this year. So a big surprise to the downside would be the best opportunity here for the Aussie. If we saw a big drop and it came in much lower than markets were expecting, then you would see a rapid repricing of the first rate cut for the RBA. So Aussie New Zealand dollar selling would be quite decent if we saw reasons for much lower than expected Australian CPI data. Check it out near the time for the minimum and maximum forecasts. If it comes in very hot, that just keeps that Australian dollar expectation that the RBA will have to be sort of higher for longer. So the best opportunity that I can see here would be on a miss in the data, because that's not really what's expected at the moment. Chinese manufacturing PMIs and services PMI data is coming out. Chinese data has been in a lot of focus recently and been a continued disappointment to markets how China's economy is doing. Best opportunity will be on a surprise beat to the upside. Now, we did have some stimulus, a heavy stimulus from China last week with the reserve ratio requirement cut by 50 basis points. That helped lift China 50, it's helped lift sentiment towards China. But a lot of analysts are saying, yes, it's short-term good news, but long-term, the same structural problems remain. So if we start to see a pickup in the PMIs, that will give a little bit of another boost temporarily for sentiment towards China. Could see the Antipodeans gain on the back of that. Aussie, New Zealand dollar, obviously watching what happens with the CPI print as well for Australia. Now heading into the rest of the session, you can see German data, French data, not necessarily expecting much movement there. We've got the inflation data coming out for the German regions. If we start to see big surprises in the inflation data, that will impact expectations for the Eurozone inflation data on Thursday. And that will be significant. If we start to see big surprises in the data, we can see a move in the euro. Again, best opportunity would be in a surprise drop. A surprise drop in inflation expectations and look for euro selling. If you start seeing this coming in much higher than markets are expecting and hot, then I'd look for euro pound upside. Could be very attractive ahead of the Bank of England and expectations that they're going to start signalling a dovish tilt. Canadian GDP, the last Bank of Canada decision was more sort of dovish around the margins, so a big drop in Canadian GDP, then you could look for a little bit more CAD selling, maybe CAD yen with the Bank of Japan's perspective that they're looking to exit negative interest rates. That's certainly one to look at on Wednesday 1:30. We obviously have the Fed meeting then coming up Wednesday evening. Now, the main issue here with the Federal Reserve is they've signalled 3 rate cuts this year. Short-term interest rate markets, as you can see here, have signalled 5+. Okay, and they're seeing rates down at 4%. So that is 5+ interest rate cuts that short-term interest rate markets are expecting. So with that strong data that we had out for the US last week, 3.3% uptick in GDP. Now, that's a strong US economy. So you're expecting the Federal Reserve to maintain that more sort of, we're very cautious about cutting rates. We're going to be tentative, see how inflation's doing. So there shouldn't be any change at the moment. And, with the sort of stronger data we've had out of the US recently and inflation falling, first rate cuts probably seen around May. What the US signal is going to be very, very key. And I'm expecting them to keep pushing back against market pricing. So expecting dollar strength into the Federal Reserve meeting obviously makes sense. And it wouldn't be surprised to see the US dollar gain temporarily out of the meeting as well. And that could be a decent headwind for gold. So you can see some gold downside out of the Federal Reserve meeting, some stock downside as well, particularly if the Fed's more aggressive and start, talking about higher for longer, 2 rate cuts, maybe, we'll see how we do if there's very tentative language. There's no summary of economic projections, I don't think, for this initial meeting. So we're not going to get like dot plot projections, but it'll come down to the language in the statement, and obviously any communications from Powell post-meeting will be crucial. Fed's blackout period until we get there. Thursday data, got some more PMI prints, got the German inflation, got the Eurozone inflation data. Now that's going to be very, very important. There's some final PMIs, but it's final readings, so shouldn't move the markets too much. The Eurozone inflation data, that will be interesting. Now, if you look at Eurozone inflation, you can see the core is continuing to drop lower. It's heading towards the 2% target. The headline, 2.9, a little uptick in the December reading. Now, for this print for January, what will be interesting here is any significant drops to the downside, then markets will start bringing forward rate cut expectations. Again, we should get a sense of what this Eurozone inflation is going to be like from the German region and the regional prints that we have coming up like on the Wednesday. So you've got the CPI, German data. So by the time we get to Thursday, we should have a decent sense of where the data's going. If that starts ticking higher, then euro pound upside looks attractive, particularly ahead of the Bank of England. Now, with the Bank of England decision, you can see that last time 3 members, Mann, Haskell, and one other, was voting for a rate hike. Now, we did see a bit of a surprise uptick in UK data. Now, let's just see what that is here. Yeah, UK services inflation was a surprise uptick for December. That did take markets by surprise. And the Bank of England, the last thing they want is inflation getting out of control in the UK. So what we're expecting is for them to vote 9 for no change. So those 3 that voted for a rate hike, the UK economy starting to slow. Increasingly, analysts are expecting the Bank of England to start signal interest rate cuts. They haven't done so. Bank of England's Bailey's been very firm. The job's not done. Inflation's still too high. We've got to hold the line. So, will they vote for hikes? Unlikely now. But the movement in the pound will be very interesting. So, if we have like an 8-1 move, so if we have 8 people vote for a unchanged, but 1 person votes for a hike, well, I look for some pound upside. Okay. And you could see that euro pound keep tracking lower, but you could see a little bit of snap higher in the pound dollar if we see 1 person voting for a hike. Now, if you see 1 person voting for a cut, then look for euro pound upside. And it'll also come down to the communication as well. So they're expected to start, remove the bias for rate hikes. They're expected to do that. And they should stop saying, we need to keep hiking interest rates. But they do have a line in the statement that they need to keep rates high, for an extended period. So if they drop that line about, we don't need to have rates high for an extended period, then that would be seen as a dovish move and look for euro pound upside, depending on what comes with the Eurozone data. So for now, looking ahead, you could just look for pound selling. So if on the statement they drop the line saying about keeping rates, for an extended period, then that will be more dovish. They're starting to move towards rate cuts. And the pound has been, quite well bid over the last few weeks. So markets really want an excuse to sell the pound in line with the broader sort of trend and outlook. S&P Global Manufacturing PMI prints coming later, but it's the final reading. ISM PMIs and prices paid will be more interesting, and that will be interesting post the Federal Reserve. Manufacturing data continues to be sort of a source of disappointment. It has been picking up in recent readings. So the best opportunity here will be a super hot reading, anything that's surprising. Keep an eye on the prices paid. That's a good indication of how inflationary pressures are brewing. If the PMIs of print comes in higher, the markets are expecting prices paid lower. That's sort of quite a hot reading and could see a little bit of upside in equity markets. But obviously, we've got to read this in light of what happens with the Federal Reserve meeting. Non-farm payroll, going to be very interesting on Friday. Reading a lot of different reports about this. There's seasonally adjusted factors for the January print. Now, it's things like that allows for things like seasonal hires, people taking on workers just for the holiday period, teachers, etc., etc. So this will be adjusted to allow for the seasonal adjustments. And generally speaking, if you take a look at the print, you see January last year, 472,000 jobs were added to the US economy. So I'm reading sort of conflicting reports that, some analysts expecting a real boost, well above market maximum expectations because of the seasonal adjustments. Others saying that there's some net revisions of the whole payroll data from last year. So there's a bit of uncertainty about this print. So it could be quite a wild print, and it could definitely come in, outside of market consensus. But be aware that the print could be written off as it's just a seasonal adjustment. It's just a change we're having to get used to. It's rather than indicative of a fundamental shift. So just be careful of the data on Friday. For explanations immediately after the event, explaining the data away. But generally speaking, remember the general relationship. Strong wage data is showing that the market is expecting inflationary pressures, because if a lot of people are in work, that means they can charge, they can demand higher wages, particularly if it's a tight labour market. And if there's higher wages being paid, that in turn will lead to higher prices. So a strong labour market is perceived by the Federal Reserve and by the market as an inflationary floor. So if it's a big miss, it's seen as deflationary and will start open up expectations of rate cuts. So stronger, coming in 180,000 plus unemployment rate, that's super good, coming in 3.6%. If the average earnings is, coming in super hot, that will be inflationary, dollar upside, but yields higher, dollar yen higher. And if it comes in, big disappointment that non-farm payrolls, sub 140, unemployment rate 3.9%. You see average earnings coming in well below what market's expecting. That would be deflationary. You'd expect bid to come into bonds. You expect the dollar to fall. You expect upside in gold, upside in euro, US dollar. So that's the expectations. US Michigan sentiment data is the final data, so shouldn't expect much. So quite a varied week. There's quite a lot going on, and obviously with the Federal Reserve meeting, we should at last get a bit of clarity on what's happening with the dollar. See this recent sort of dollar moves. You can see this indecision we've been having here. Just chop, 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 chop. Doesn't really know which way to go. Do we go with the Federal Reserve 3 rate cuts, bit of a pullback, or do we go with the market saying 5 plus rate cuts? The Federal Reserve meeting should bring a bit of clarity to that and should allow the dollar to break out of its 104, 103 range.